Hey everyone, Mark Yaxley here for Strategic Wealth Preservation, SWP. Welcome back to another episode of Inside the Vault. Today's guest is Mr. Kyle Floyd, a good friend of mine. Kyle is the CEO of VOX Royalty, a publicly traded precious metals royalty company listed on the Toronto Stock Exchange. The reason that I invited Kyle to appear on today's show was to learn more about precious metal royalty companies. This is something that was introduced to me a few years ago, and it's a topic I still want to learn a little bit more about myself, and I'm sure one that a lot of our followers are also interested in learning more about. It's an interesting model to expose yourself to precious metals and an alternative to investing in more traditional mining companies. So please welcome Kyle Floyd to Inside the Vault. Kyle, welcome to Inside the Vault. I'm very excited to have you here, my friend. Listen, I didn't know much about precious metal royalty companies before I met you a few years ago. It's a topic I still want to learn more about. And I'm sure our followers also want to hear more about the model, why it's a good investment, why it's a good alternative to more traditional mining stocks. So welcome, Kyle. Looking forward to hearing your thoughts today.
Yeah, thanks, Mark. It's really good to be with you today. You know, royalty companies are not let's call it the most well-known play in the commodity sector. And I think for a lot of investors out there, obviously, your focus on the physical is that safe, secure, know you have it. And I think there's a tremendous amount of value in that. And I think it's a key part of anyone assembling a portfolio where they're trying to protect their wealth and grow their wealth. I think physical has to be a key part of that. But what often happens is investors will also branch out to maybe get a little bit more leverage, maybe look at different types of forms of riskier exposure, and they end up getting led to mining companies. And in certain cases, those opportunities can perform. But if you look back over the last 20 years, mining companies have been probably one of the poorest performing asset classes, mining equities, that there's been. And there's a lot of reasons for that. And a lot of investors are drawn to mining companies because that inherent leverage they believe to be there in the form of precious metals and what's in the ground and yet to be mined. But the reality is mining companies have a lot of inherent flaws that royalty companies don't have. And royalty companies present what I believe is a better risk-adjusted return than a general mining equity, and by a significant margin. And if you look at what has happened in the markets for the last 20 years, royalty companies have really been the high flyers in terms of share price performance. And mining companies have really struggled to perform well for their shareholders. And I think there's a lot of reasons that go into that. We can certainly dive into what those are, but royalty companies have been not as well understood, not as well followed. And I think they present a really nice opportunity for your viewers and a complement to owning physical in their portfolio.
So can you take a moment, Kyle, to just expand on the basic principles of the royalty model? How does this work? If someone's never heard the term, precious metals royalty company, how do you guys operate? How does your model work?
The beauty of it, Mark, is that it's really actually quite simple. So the royalty is essentially an interest typically in the top line revenue that's generated from a mining operation. And so what VOX does is we focus on acquiring what we call third-party royalties. So that's someone like yourself, Mark, that maybe you had a grandfather that owned land or a ranch in Nevada. And we actually have had this situation play out. And the grandfather leaves this interest in the estate. They held the land, they sold it to a mining company that wanted to go develop it into a gold mine. And what they kept in return was a royalty over the future production and revenue generating capability of that asset. And so VOX will go look at buying those interests. Those are really non-core interests for you. You might have other interests that you want to use that capital for estate planning purposes, you name it. And so we buy those, what we call third-party royalties, all around the world. But what a royalty is really entitling the royalty owner to is that top line revenue in that project without sharing in any of the cost structure. So if a mine generates $100 million in revenue tied to gold production, if we have what's typically called a 1% NSR, net smelter returns royalty, essentially means 1% of revenue, we would generate $1 million a year off of that mining operation. And the beauty of that is we don't share in any of the costs, fixed or variable, that mining company experiences to bring those ounces to the ground and sell those ounces. And so what that protects against is you might invest in a great mine, but they have cost overruns. They have pressure on their variable cost structure, which could be people, it could be infrastructure, it could be diesel, it could be equipment that starts eating away their margins, we don't share in that cost structure. And if they have to go back and raise capital, usually it's in the form of equity, or most oftentimes in the form of equity. And then what that means is that per share interest in the revenue or cash flow that you thought you were generating from that mining opportunity gets diluted. The royalty company does not share in any of those costs, but it shares in the upside. So when a mining company goes and puts money towards drilling and increases resources and reserves and puts money towards infrastructure and is able to either get into production or increase production, we realize the benefit from that. But that's a compounding benefit at no additional cost. So this mining company might have really interesting opportunities, but they've got to continue to fund those growth opportunities. We get those growth opportunities and we don't pay anything additional for it. So in an environment where you have precious metal prices rising, that's incentivizing the mining company to go explore more, bringing more resources, leading to more reserves, leading to more production, which then further incentivizes more exploration, more resources, more reserves, more production at higher prices. So you get this compounding effect, but we don't have to contribute capital to bring that value and bring that revenue forward. And that's what royalty companies offer to investors. And it's not a very well understood part of the capital markets and let's call it commodity equities that most investors know about. So it's exciting to bring this opportunity set to your viewers.
So how does VOX identify a good opportunity to pursue? You mentioned that you have royalties all over the world at this point. How do you go about identifying where to invest?
Yeah, it's a very good question. And royalty companies have to decide how they're going to, what's going to be their strategy for creating value for investors. And our strategy is taking a global approach. It's a precious metals focused approach, but it's somewhat organic in that gold has been the most explored for commodity since the beginning of time. So what you need to create a royalty is assets and geological anomalies essentially to change hands. Well, gold assets have probably changed hands more often than any other type of commodity. And so there's a lot of gold royalties out there for us to acquire. And what we did was we built a database and acquired a database that has 8,000 proprietary royalties all around the world. And so what happens is complementing that is a technical team, mining engineers and geologists looking for the best assets around the world that have the best royalties over that assets. And then we have deal sourcing agents all over the world that help connect our team when we're not in that specific jurisdiction to these disparate sellers that these assets are non-core for, meaning these third-party royalties. And we close that loop and acquire what we believe are the best assets with the best royalties at the best value. And so that is our business model. It's a precious metal focus. That being said, if we find a really interesting battery metal project that we like the technical fundamentals and the value lines up and we expect it to be in production in the relatively near term, then we'll bring that into our portfolio. But that's the strategy for VOX. And we believe that strategy will yield more value for investors than any other strategy in the commodity sector when you calculate risk and the returns that you're expected to generate.
Okay, I'm really starting to get a grasp now, Kyle, for the model. And I really like the idea that you're removing the royalty model, removes quite a bit of the risk associated to traditional mining equity stocks. I wanted to ask you, though, there's a lot of royalty companies on the market, even though, it's like you said, it may be a little bit less known as an option to investors, but there are a number that have been quite successful over the years. And my next question to you is, how do investors determine, which royalty company they should invest in? What are three things that makes a royalty company a good pick for investors?
Yeah, Mark, it's a great question. And I think it's a question that every potential investor should ask is, what if it's whatever the industry, whatever the equity is, why am I picking this particular company? Why am I choosing to invest my capital in that company? And that's a pretty serious question. And I think the first place that most investors should start is really an evaluation of the management team. Do they have expertise? Do they have track record? Do they actually have the capabilities to accomplish the mission that they say that they're trying to accomplish for shareholders? And for us, that's creating and building value in the royalty sector at better volume, at better prices than anybody else. Well, our team has 40 years of collective experience in the royalty sector, more than $1.5 billion of transactions over royalties, and a very technical team. You need mining engineers and geologists, and that's one of the benefits that a royalty company should be presenting to you as an investor and a shareholder. is that they have the technical capabilities to really understand the asset. So you don't have to do that work. You don't have to go understand what the geology is. You don't have to understand the engineering risk. We have people that do that, and they've done it at a very high level and have a tremendous amount of expertise with that skill set. And so that is something that I think all investors should look for when they're evaluating a royalty company is, do they have a technical team, and do they have a track record of success? And do they have that let's call it multi-cycle experience? It's one thing to be investing when everything is rising. It's another thing to have seen what it was like in 2012 and 13 and 14 when metal prices were falling, and making sure that you're building in the appropriate risk and the expectations for your return around that risk. And I think we really do that well. The other thing that you need to look at is, what's the quality of their portfolio? What's the duration of cash flow? How many assets do they have? Are they over good assets? Are those assets expected to come into production anytime soon? There's a lot of royalty companies right now coming out there, and they find these obscure projects, in the middle of a jungle somewhere with, no infrastructure, and very questionable jurisdictions at that. And then they try to say that, well, there's so much upside potential. Well, there's probably not really that much upside potential, because you as the shareholder and us as the royalty company, at the end of the day, for these things to have tangible value, they eventually have to get into production. And that's what you're looking for. So how many production stage assets do you have? How many development stage assets do you expect to come into production? It's the quality of those assets. And then do you provide a tail of optionality? Do you have exploration portfolio within that overall portfolio that has some very exciting things happening that should drive value that you're really not paying for? And so VOX has all of that in our portfolio. And then lastly, as with any business, what are their competitive advantages that set them up for success, and to use a portfolio management term, alpha in their industry for the long term? In VOX, we have a huge competitive advantage in the form of our proprietary database covering now more than 8,000 global third-party royalties all around the world, our deal sourcing agents that we've been working with and investing in for almost a decade, and a technical team that has a terrific track record of finding very valuable royalties at reasonable prices, at great volume all around the world. And so those are the three main kind of key criteria I would look at in evaluating any royalty company that I was presented with.
Thanks, Kyle. That all makes sense. And I appreciate you clarifying what investors should look for when doing their research about royalty companies. Now, a tough question for you. And, with any investment, there's always the downside. There's always the risk factor. Now, we talked earlier about how royalty companies actually remove some of that risk from the equation, but I know that no model in business or any company that you could potentially invest in is perfect. So what is the downside when investors are thinking about investing in royalty companies? Where does the risk lie?
Yeah, ultimately, we're always relying, because we're not the operator of mines. And while that's a huge benefit, and I think that drives a lot of the risk-adjusted positive performance for royalty companies, still at the end of the day, we have risks around when we have a royalty over mine, that mine going into production, which will ultimately generate the revenue for the royalty company and for our shareholders. So if that doesn't happen, we're exposed to that risk. Or if a mine is in production and goes out of production, which we've seen with a lot of royalty companies, and that really is long-term damaging to the royalty company, and that you're counting on that cash flow and it's no longer there. So at the end of the day, we are still attached to the success of these mining operations, yet we're not running the mining operations. We don't want to be, but at the same time, if a mine is not ultimately successful, that hurts us as the royalty holder. But one of the advantages is typically a royalty will run with the land and be attached to the mine, even if it goes in and out of production. So if it were to go bankrupt, in most cases, the royalty is still attached to this parcel of land and to the resource that's in the ground, and will continue on when another company comes in to mine that operation. So it still has another layer of risk protection built in, but we are at the end of the day tied to the success of mining companies, and then also therefore tied to metal prices, where we're pricing our asset acquisitions at a metal price lower than where the metals trade today. But if they were to fall to a level where mines are just not able to produce cost effectively, that would hurt us. But again, we're looking for those assets that can withstand a significant drop in metal prices and still be highly successful. Most of the royalty companies that compete in our end of the sector need higher prices for a lot of those projects to work. That's very contrary to the way that we evaluate opportunities and which opportunities we bring into our portfolio, which I think mitigates a lot of risk for investors.
Hence, the strength of your management and technical teams helps you make those selections. And where the price of precious metals seems to be heading right now, I think the potential for mines not to want to operate at these price levels is fairly insignificant, I would imagine.
Absolutely. And look, at a personal level, I think, this looks and feels a lot like 2006 to 2008, where there were so many markers of just rampant, fiscal recklessness, massive inflation, the underlying economy not, maybe not doing as hot as it really looks. It just feels all like that time period. And so, I think that period was, and ensuing the great financial crisis was one of the most productive times ever for gold. I think we're in that environment. That being said, we're disciplined capital allocators. We are finding the best investments, and we're not baking in that expectation. In fact, we bake in an expectation that prices are likely going to fall. That's not a personal belief. But from an investor standpoint, that's what you want. You want to make money with our company in VOX, whether metal prices go up or down. If metal prices go up, like I think most of probably your viewers and I personally expect them to do, that's just a huge tailwind that really kicks in for us, that really turbocharges those returns. And we've seen that play out. One of our exposures is to iron ore. Well, iron ore is almost all-time high prices. And that's driven, our ability to go out, increase revenue guidance, exceed all expectations we had, because when those things happen, we don't have to contribute more. There was an open pit that opened up that had been exploration that then came into production that we didn't expect because the prices were so high. And that was all benefit at no additional cost for us. So we really try to take a lot of the risk out for our investors and our shareholders. And I think we do a really good job at that, but we still give you that immense leverage when metal prices run.
Excellent. Kyle, we have a few minutes left. I want to talk a little bit specifically about VOX, about your company. I'd like to share my screen, so just bear with me for a second here. So one of the strengths of VOX when we were chatting earlier was the growth, the exponential growth that you're experiencing. Can you elaborate on why is VOX, experiencing this type of growth, and is this expectation, or is there an expectation for this trend to continue?
There is, and we came out recently and we doubled our revenue guidance. We had previously been expecting around 2 million Canadian top line revenue. We then, a few weeks ago, were able to double that revenue guidance between 4 million and 5 million Canadian in top line revenue. And it was really significant for us because we have 5 production stage assets. Essentially, every single one of those assets has been delivering record production for us. And that's equated to 492% average revenue growth over the last 2 quarters. And that's really driven by our business model, and I think validates our business model. We're looking for royalties that are typically pre-production, anywhere from 3 months to 24 months out of production, and looking for assets that our mining engineers and our geologists and our technical team feel really good about. They believe that the risk-adjusted return of where we're buying these royalties is going to play out well in the favor of our investors. And this really has validated that approach. We probably have one of the highest return on invested capital metrics in the space, if not the highest, certainly of any of our peers. And so this last quarter was really important because I think it validated our business for the markets and for investors of our ability to find royalties at great value, right on the precipice of production where they probably are the most attractive, and then actually having those assets come into production and deliver what we thought they could deliver. And so it was a really exciting quarter for us and a really exciting period of growth for our business.
That is really exciting. And I know when a business turns a corner, it injects a lot of energy into the management team as well. So I'm sure that's very exciting for you. Another thing that I noticed when I was reviewing VOX's documentation is you made the comment in the documents that you feel that the stock price is undervalued in comparison to some of your peers. Do you care to elaborate?
Yeah, Mark, I think we're significantly undervalued, not just a little bit undervalued. I mean, if you look at this peer chart that you have up in front of you, I mean, our closest comps are trading at very meaningful relative net asset multiples that are far more, significant than where we're trading at a relative level. And I think we're going to close this gap. I think our business model is stronger. I think our track record is stronger. And I think the growth that we're going to continue to deliver is stronger. We've caught a lot of our closest peers in terms of revenue growth. We've done it by investing less capital. And I think investors are going to start to appreciate that our business model is really realizing alpha in the royalty sector and will continue to do so on a long running basis. So I believe this relative valuation multiple is going to close. This gap is going to close, but we don't need it to close. We're going to continue adding immense value for our shareholders accretively, finding royalties at less value than what we're trading at, and bringing those in volume with over interesting assets into the portfolio. And if you look at that slide, that the growth assets that we have below the line that we're expecting to come into production 2022 to 2024, we have more interesting development stage assets than any of our peers that have relatively direct line of sight to becoming production stage assets over the next few years. So that's going to continue to fuel our growth. We're excited about that. And then one of the things that we don't have time to talk about is the tail of exploration assets that we have and the abundance of good news that's coming out of those opportunities that's going to fuel, again, this continued deliverance of more revenue and more growth for our shareholders, and what I believe will be eventually also a closing of that relative valuation gap between us and our closest peers.
Kyle, look, I want to thank you for your time today. I've learned a lot about royalties. I feel more comfortable with the topic. I believe our followers probably feel the same way. I'm sure they're going to go check out VOX. We're going to list the company's information in the video description. So if you're interested in learning more about VOX and obviously the website details, we'll put that in the description for you guys. I know Kyle personally. I'm not endorsing VOX necessarily as a stock pick, but as a person, I've known Kyle for a number of years. This is one of the hardest working people I've ever come across in my life. So if you're looking for a personal endorsement on a hardworking guy who is leading this growing company, there it is for you. Kyle, I want to just finish by saying, aside from thank you for your time, we are both going to be at the Silver Symposium, which is coming up in just a few weeks' time. And I'll just flash that on the screen for a second. It's a mining-focused conference happening in Coeur d'Alene, Idaho. Really looking forward to seeing you there. So again, if there are any investors that want to learn more about the mining sector, more specifically about royalties, meeting Kyle and the VOX team, we're going to be there, right?
It's going to be exciting. I mean, face to face, Mark. It's been it's been over a couple of years since we've been able to get together. So yeah, I'm really looking forward to it. For anyone that's going to be there, reach out to Mark, reach out to myself. Would be great to catch up. Exciting to see an in-person event on the calendar.
Awesome, Kyle. Well, again, thank you for your time. Good luck with VOX. We'll be keeping an eye on it and wishing you a great day.
Thanks, Mark. It's been a pleasure.